Would you rather risk rupees 1000 to earn rupees 1000 or rupees 100 to possibly earn the same rupees 1000? That's the power of call option buying. High reward, limited risk, but only if you play smart. Hi, I am Pranav VK, an NISM Certified Trader and Trainer and your options trading coach here at Stockshala by Kotak Securities. In the last video, we understood what exactly is call options and how you can lock in your stock price by paying a small amount. In this video, we are going to go one step further and understand what exactly is call option buying and how traders use it to make money from it. Buying a call option is like saying, I believe the price of this stock is going to rise. I want to profit from it, but without risking my entire capital. It's a bullish bet, but with limited downside. Now let's take a real market example to understand this better. Let's say the price of Reliance is rupees 2500 and now you buy a call option of rupees 2600 at a premium of just rupees 100. Let's say the lot size of Reliance is 100, which means to buy this contract, you are paying 100 rupees into 100, that is rupees 10,000. Now imagine this, the actual price of Reliance is rupees 2500 and if you had to buy 100 shares of Reliance, then you had to shell out rupees 2.5 lakhs. But in this case, by buying an option contract, you are able to get the big exposure by a small premium payment of just rupees 10,000. Now since we have bought the option contract with a strike price of 2600, even though Reliance is at 2500, let's look at the various scenarios in case the price goes high, the price stays flat, and if the price goes lower. Now let's understand scenario 1, where the price of Reliance is going from rupees 2500 to 2800. Now that you have already bought a strike price of 2600 by paying a premium of rupees 100, as and when the price of actual Reliance goes up, the price of the premium also shoots up. Now since Reliance has gone from 2500 to 2800, probably the premium also has gone from rupees 100 to rupees 400. Now one thing that you have to remember is that in options contracts, you are actually trading the premiums and not the actual stock itself. So now that you have bought the premium at rupees 100 and now when it shot up went to rupees 400, your actual profit is 400 minus rupees 100, that is rupees 300 per share. And since the lot size was 100, your total profit is going to be 100 into 300, that is going to be rupees 30,000. And as you can understand, you invested initially rupees 10,000 to enter into this contract and finally the profit was rupees 30,000, and that is actually very rare in the stock markets and hence most traders are attracted towards options trading. Now that you have understood scenario 1, let's go to scenario 2 where the stock price might stay at 2500 or go even below that, which means your view was wrong. In this case, you are going to lose the entire premium of rupees 10,000 that you have paid to buy this contract. Think of it like an ice cube. As and when the day passes, the ice cube continues to melt until and unless the surrounding environment is cooler. Now let's talk about scenario 3 where the price of Reliance is matching the strike price of what you have taken. So even in this case, if Reliance is 2600, which is equivalent to your strike price of 2600, the option that you have paid is going to be worthless and you're still going to lose the entire amount. As you can remember from the previous video, the option seller is the winner if the price stays flat or even if the price goes down. So similarly, on the other hand, as an option buyer, you're going to be the loser. Even though options feel very powerful, they expire fast and time decay is your biggest enemy if you are an option buyer. Now don't worry if you're wondering what exactly is time decay. We are going to be covering this concept in detail in the upcoming videos. Now let's discuss the risk to reward as a call option buyer. As a call option buyer, potentially you are risking rupees 5,000 to make a potential reward of rupees 15,000. So you are actually limiting a very small amount of capital to get a very high reward. But the important aspect to remember is that you need timing, direction, as well as the right amount of movement only then can you make a profit as a call option buyer. And as you can remember, the probability of profit as a call option buyer is only 33%. So which means 66% of the times you are losing money. While you have unlimited profit potential, it is important that you focus on higher probability rather than higher profits. So probability is always greater than higher profits. Traders often buy calls during big events because that is when they expect the volatility to be high, and that is when the price is going to shoot up very quickly. But more often than not, they end up losing a lot of money because these high movements do not sustain for a very long period of time, and more often than not, it does not happen continuously. Now that we have understood what exactly is call option buying, the risk to reward associated with call option buying, here is the payoff diagram of how a call option buyer looks like. Let's take coins as a fun example to understand this even better. Imagine this is the underlying asset MRF and its value is 35,000 rupees per stock. Now I want to buy a call option contract and I'm expecting the price of MRF to go higher. But in any case, let's understand this one by one. And imagine I want to buy this call option contract, then I have to pay this premium so that I can get inside the contract. Now I am taking a strike price of rupees 35,000 itself to enter into this specific contract. Now there are three scenarios that is possible. If the value of MRF actually goes higher in the specified expiry date that I am expecting it to be, then in that case I am going to be profitable. So if I am profitable, this is the amount of money that I am going to make. And if it goes even higher than that during this time, then I might make even a higher profit, because as a call option buyer, I have unlimited profit potential. But in the case where the price of MRF stays as it is, then in that case, I'm going to lose the entire premium that I paid. So even in the case where the price of MRF goes below my strike price, even then I'm going to lose the entire premium that I have paid. So as you can see, 1 out of 3 scenarios I am profitable if MRF price goes significantly higher, but whereas in the other 2 scenarios I am losing the premium paid. So hope this example gave you a better understanding of how a call option buying works. Here is a quick recap of what we have learned so far. We have learned that a call option is a financial contract which gives you the right but not the obligation to buy a specific stock at a fixed price called as the strike price before a certain date called as the expiry date. We also learned that as a call option buyer, you are bullish on the underlying stock and you make money only 1 out of 3 scenarios. We also learned that you are going to enter into a call option buying contract only when you want to risk less capital, but at the same time you expect a quick movement in the underlying asset. And finally, we also learned that we are willing to lose the entire premium in case our direction or our analysis is wrong. And finally, it's not a magic trick. It's a timed contract that rewards fast price action. In the next video, we are going to flip the script and talk about selling call options and whether you should be doing call option selling or call option buying. It's a different risk profile, different rewards, and a different mindset altogether. So if you like this video and understood all about call option buying, then go ahead and share it with your friends. And you're watching Stockshala by Kotak Securities. I am Pranav VK and I'm going to see you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.